Has private capex picked up? That's the question we are asking today. The government has done its bit in the past 4-5 years. India's investment to GDP ratio has jumped from 28% of GDP in FY21 to 34% in FY24, the last year for which we have full numbers. But much of this increase of investment to GDP has come because government capex has jumped from about 2.9 trillion rupees in 2017 to 9.5 trillion in FY24, and the budgeted number for this year, 11.1 trillion. But what about private capex? Now, the data I have is from RBI. The Reserve Bank of India report shows that private sector, they've only looked at borrowing from banks and the market. Presuming that people would have borrowed for capex, that borrowing has gone up from 1.96 trillion in FY22 to 5.65 trillion in FY24. That's, more than double, 2.5 times. So has private capex picked up, and where is it headed in FY26? That's the question we're asking two stalwarts. Mahesh Vyas, Managing Director and CEO at CMIE, the organization which has the best data on projects, and Dharmakirti Joshi, DK Joshi, the Chief Economist at CRISIL. Gentlemen, thank you very much indeed for your time. Mahesh, you have given us a wealth of data. Take us through those. There, it does look like projects, new investment projects did rise in FY23, but seems to have fallen off thereafter. But Reserve Bank data is giving us a different picture. It looks like it's more than doubled in FY24 from FY22. Tell us, what are your trends?
So we look at two different ways in which CAPEX is moving along. We look at the CAPEX database and we look at the prowess database. In the CAPEX database, where we track two things, principally, which is the announcement of new large capacity projects, and we look at their completion. So steadily, people keep announcing new investment projects, then we track them over their life cycle till they're completed. And as we take snapshots every quarter, we get a time series of the rate at which enterprises are proposing new projects and completing them. What we are finding in 24-25, the first 3 quarters, is that there is a slowdown, and a significant slowdown in the announcement of projects and in the completion of projects. So while there was a big pickup in 22-23 and 23-24, at least in new investments and in completion, we expected some slowdown from there. But the slowdown is lower than even the past average. So it's a bit disconcerting that both new investment proposals and completions have slowed down in 24-25.
Okay. No, it is a bit worrying. One hopes that the slowdown is because government capex slowed, and therefore ancillary investment probably slowed. I'll come to that in just a bit. Mr. Joshi, how would you look at the trends and the data that CRISIL has?
Well, I think if you look at the CSO data, you rightly pointed out that the driver of capex has been government, and the household sector. The housing sector has done well. The corporate sector, I think, has the official data also shows that it has been moving very gradually. And I think from a very macro perspective, I think one of the reasons why private capex has not been forthcoming, despite, I think, the very favorable conditions, the preconditions, so to say, whether it is tax rates or it is, let's say, the PLI scheme, industrial policy of the government, or it is the ability of the private sector to invest, which is reflected in the leverage, low leverage they have. So there is a lot of capability to invest, but I think it's not reflected in the ground. Now, I think here one of the reasons I think which has been playing out for last few years, I think, has been the global uncertainty in terms of the tariff policies. I think it's not. Now it has become much bigger. I think if Mr. Trump comes, I think that's going to create more uncertainty from the global front. Let me explain how it plays out into the investment. Well, I think when US raises tariffs on China, China has overcapacity. They have deflationary pressures in the economy, which are already playing out, which might intensify if I think if Mr. Trump goes ahead with what he said in his election campaign, that the tariffs will increase. Now that will create further deflationary pressure in China. It will slow down the economy, so their exports to other countries will become even cheaper. We already import quite a lot from China. So right now, I think what I'm trying to point out is that the capital-heavy investments, I think, which require some certainty, I think they take a backseat in such a scenario. So I think that's one of the reasons. And then I think even the domestic demand has been a bit uneven. I mean, so to say, if you look at the GF's gross fixed capital formation, I think that has risen by 29. It's 29% higher than what it was in 2019-20. But the consumption is only 17% higher. GDP is only 19% higher. So there, I think, the demand unevenness also plays out, but not to that extent. And I think CSO was planning to do a intention survey. I think that kind of survey would throw further light on why I think the private sector has not come forth to that extent. But to me, I think the uncertainty plays a pretty big role, I mean, at this juncture. So you are in a wait and watch mode, I mean.
Okay. No, fair point, Mr. Joshi. I take both your issues. There was some data, I think it was S&P, which pointed out that in 2018, when the first Trump tariffs were unleashed, global business investment came down because of the uncertainty. And an action replay is definitely possible, and it's probably already playing out. People want to hold back and see what comes after Jan 20th. And the second point you make of consumption being lower could also be a reason why people are holding back on investments. But there can always be, of course, a flip side. I'll come to that in a minute. Mahesh Vyas, I looked at this RBI data, and it's fairly detailed. They have looked at finance raised by companies from banks, FIs, FCCBs and ECBs and IPOs, and assumed that is for Capex. Otherwise, why would you raise so much money? And there it's quite a jump from 1.96 lakh crore in FY22 to 5.65 lakh crore in 23-24. They don't have for 24-25. Isn't that impressive that it seems to have gone up, at least the money raising?
In terms of the amount raised by non-finance companies, it's very impressive. So certainly that doubling or near doubling is very impressive. But at least some of them, and not an insignificant amount, is offer for sale, at least the IPOs. So some part goes off over there. The thing is that the corporate sector is raising resources more than what it used to raise earlier, but that's still not getting translated into net fixed assets creation. So mind you, companies did not have any dearth of capital or financial resources to invest even in the recent past. Since the last 3 or 4 years, they have been making more profits than they ever made. 3x is the profit they're making since the pandemic compared to what they made earlier than that. So they are making a lot of money. So it is not about the resources at their behest. It is what they do with the resources that seems to be a bit of a worry, because that money is not going into the creation of net fixed assets. Now, if you look at the balance sheets of companies, whether it is listed companies or unlisted companies, the growth in net fixed assets in nominal terms is in single digits.
Yes.
So what Mr. Joshi was saying, that households and government sector is the source of capital formation, but not the corporate sector. But the most efficient source of corporate capital formation is the corporate sector, which is not investing. And what we see from the balance sheet is a bit shocking, Latha, if I may say, that consistently for the last nearly 10 years, as the corporate sector has been making good profits, it's parking the money into financial investments. So while fixed assets are growing in mid-single digits, investments into financial assets is growing in double digits. So it's not about the resources. The RBI's findings are fine, but what is stopping the corporate sector from putting this money into long-term capacity creation?
We are playing exactly the data that you gave us. Growth in net fixed assets was a high in FY20 of 13.6% growth, year-on-year growth. And as we come towards 23-24, it is just 6.6% growth. And in fact, we also have CMIE Provis data for H1, of the current year. And even over there, we are seeing a fall from 7.8% last year to just 4.8% this year. And investments, that means people are, company treasuries, corporate treasuries are just putting their money in probably mutual funds or in shares. They're just investing. They're not putting into concrete fixed assets. That's what the data is indicating, at least for the last 2-3 years from FY22, as it were, and that's a little worrying. Mr. Joshi, can it play the other way around? You raised the China worries, uncertainty as a worry, but that can also mean that the China plus one factor can work. We have seen a lot of even Chinese companies making investments in India, and definitely Apple and a whole host of mobile phone companies, laptop companies coming in. So can it play positive?
Yeah, it can play positive. I think you're right. Let's look at the nature of corporate investment that is taking place. That will provide an answer to what you're saying. I think steel and cement are doing well because government is creating infrastructure. And so the prospects for steel and cement investments remain quite bright for the next 3-4 years, according to CRISIL assessment. Now, if you look at the industrial policy of the government, which also promotes private investment via incentives, here, I think we've seen less capital-intensive segments like your electronics or pharmaceutical. They are the ones which have done well. So there, I think the ratio of capex to sales is quite low. Now, in the next phase of PLI, I think we will see the movement towards more what you were mentioning. I think more capital-intensive stuff, which is mobile, solar panels, etc. Here, I think you will add more value, and we've found that in the past that where the value addition rises, the capex intensity also rises. So you will see this play out, and the PLI is going to peak in 26. So I think you'll see some traction in 25 and 26. And then I think also what needs to be kept in mind is that the newer emerging sectors are now going to play an important role in the capex cycle from the private sector. And here, I think I just want to point out that when you get into a newer area, you also have newer risks, but you don't want to miss out. So I think that balancing has to be done, and so that kind of makes the corporate sector a little cautious. But 40%, according to S&P, 40% of the investments in the next 10 years from the conglomerates is going to come from newer areas.
Got it. Yeah, unfortunately out of time, but thank you very much, Mr. Vyas and DK Joshi, for giving us a very clear idea that the private sector has not yet quite picked up the baton. It looked like that in FY22 and 23, but we are seeing corporates making money hand over fist, but keeping it in financial investments and not creating fixed investments. Hopefully, the trend should change. Thank you very much. That's it on this edition of Bazaar. After a break, it'll be time for Chartbusters.